That's it.
That's right. So, yep. So we're just waiting for. Oh, is that Tanisha Roby? Can she hear me? Holy smoke! Got a got a friend from Alabama.
That's awesome.
Are
If
you
you have
trying to
any
say I'm not your
questions.
friend, Daryl?
Oh no, I'm not saying that. I'm not saying that. All right. So, all right. Well, everyone's coming in,
You
and we're
know
just
I'm
waiting
letting
for
you,
the
man.
host.
You can keep talking.
We're just waiting for the host. All right. Here's Joseph. How you doing, Joseph? But Joseph, you need to come on into the mastermind group. Oh, Robert Beardsley, he's here. All right, he's here. So, everyone out there in Facebook land, I'm going to have to stop the stream at this time. If you're not here, I put the link down inside the Facebook thing. All right, register. Come on in because we have a special guest, Robert Beardsley. He's the author of the Definitive Guide to Underwriting Multifamily Acquisitions. So this is where you need to be. Sorry, I gotta cut you off, but you need to come on over. All right, I can't stay live. So come on, people, come on over. See you in a few minutes. All right, all right. Robert, how you doing?
I'm doing well. Thanks for having me.
Thank you for coming. So we have a lot registered. We have over 70 people that registered for today, and they are coming in. So I'm just gonna give them a few more minutes. Do you have a model you want to use, or you want me to send you one?
I have an example offering memorandum with financials and a completed model and also a
Okay.
blank one.
Okay, sounds good. That's good. Okay, fantastic, fantastic. All right. So what we're going to do, we're going to, as we proceed through, um, we have blocked for an hour and a half, if you need it, and if there's time left over, then we could do a little Q&A. All right. So everyone is coming in. Just give them just a minute or so. Everyone's coming in.
Next up, it's time to create a winning agenda.
All right. Alicia, I want to thank you very much for helping me out.
No problem. You always make it so I learn on my feet. So
Awesome.
All right. I just
Hey,
muted
Daryl.
everyone.
Hey, Daryl. Hey, Mark.
All right. All right. We're coming in. We're coming in. All right, so I'm gonna go ahead and get started because I really want to start on time. Before we get started, you know, we always go through the regular, and that is, do anyone have, hold on one second. All right, so I'm gonna stop sharing for a minute. Okay, so before we get started, we always go through the step. I want to welcome everyone from coming, new people. I'm gonna try to get to the new people so you can introduce yourself. All right, but so let's get started on this here. Let me see. I took a lot of notes. Is Aaron here? Is Ellison here? And is David Seeley here? If you are here, please unmute yourself.
I'm here. Daryl, what's up, man?
Okay, Aaron is here. Is Ellison here, Aaron?
I don't see him. Oh, he's here.
I see.
He's here.
Okay, I see David Seeley.
He's on here.
I'm on here.
Okay, great. All right, so okay, so for the new people that's here, let me give you a bit about. Let me tell you a little bit about this particular group. We are a commercial multifamily mastermind group. All right, and what we do, it's about collaboration. We are not about competing against each other in this room. We do not compete against each other in this room. Okay, we do not compete against each other in this room. I know I said that. I want to just make it really clear that we do not compete against each other in this room. We collaborate with each other in this room. If you have a deal, we ask you to bring it here so we can help you with that deal, to get that deal across the table. What is it that you need? Do you need funding? Do you need LPs? Whatever you need, we're going to try to get that thing done and get you and get that building acquired for you. This group, Commercial Multifamily Masterminds, is an affiliate of the GOB Network Apartment Investors. So we do have a very good reach. All right. So I want to say that. Now I'm going to say this. I'm going to turn this over just for a minute. I don't have a lot of time because we have a guest speaker today. Robert Beardsley is here. And if you know Robert Beardsley, or you may be using his model to underwrite your deals, but he's going to be going through the model. So, but before I get into that, David Seeley, he's an architect. Ellison and Aaron, you know, they are members of the group here, and they are working on a big deal in Montgomery, Alabama. So we definitely going to need your help. We're going to need your help. All right. So this is the ground phase right here. So Aaron or David or Ellison, whoever's going to take it, go ahead and take it, and just let everybody know what you're doing and what you need help in, so we could get this deal under contract.
I'll talk for the group. Basically, what's going on is it's large. It used to be a hotel convention center, and I've talked with the city officials, and they're looking to work with us to turn it into a multifamily and / residential commercial rehab. We're looking for local architects and engineers in Alabama because only certified, state certified people can project.
Ellison,
Yeah.
do me a favor. Can you put that camera on? Because if you're dealing with everyone here, they want to see who they're talking to.
Yeah, there's 6 buildings in total. We're gonna subdivide one and we're gonna make it a veterans housing for homeless vets. In Montgomery, there's 2 VAs there, and there's a large homeless population of veterans there. I've gotten the information, and it's something that we can pursue. On Thursday, I have a GC that is going to look for a few things so I can figure out if it could be, it's only 2 stories high. So we're wondering if we can on it, because that's something that the city officials told us we can do as long as it meets the minimum requirements. So yeah, we're looking for funding. And
Okay, so let's hold tight on the funding for right now, because we got to get the basics done.
right.
What you need right now, correct me if I'm wrong, because I was writing down notes pretty fast. You need someone that can help with going down to the zoning board. Am I right? Or the city?
Yeah, so whoever would be the architect or the engineer would be the lead on the project to getting all the permits and everything else approved with the city.
Okay, so if I know we have some Alabama people here, and Patrick Crabtree, I don't know if he's on. Mark and Rick, I know y'all work with Patrick. Is there any way y'all could, if he's not here, can you get a message to him that we could use his help on this particular deal here?
Yeah, I'm here, Daryl.
Oh, Patrick is here. He's here. Okay, Patrick.
Hit me up. Hit me up after this. Talk to me after this, Patrick. Sir.
Sounds good. Patrick,
Yeah,
please.
Patrick.
That's a winner. Is there anyone else in Alabama that can also assist in this project? Okay.
Errol, you do know I live in Mobile, right?
Oh, there's David.
Oh,
Yeah.
I was gonna say David Monroe.
That's right. David lives in Mobile. That's
Well,
right.
2.5 hours from Montgomery.
Yeah.
Oh, okay. Your little drive. That's a little drive for you. Okay.
Yeah, the one I'm presenting this afternoon's about the same distance.
Okay. I got you. Okay. So, all right. So that's okay. So we got that part taken care of. Now there's I'm underwriting a 10 unit that's in Texas. The numbers as of right now looks pretty good. It is below market. The rents, according to the broker, he is a KW broker. They are below market. I'm going to underwrite it. I'm going to finish. I got to do a little more research. If anyone would like that deal, let me know. I will put my contact information in the chat, and we can go ahead and try to snatch up. It's 10 units. Let's snatch that sucker up. And let's snatch that sucker up and see what we could do with it, if anyone wants to come in on this. So and I'm asking everyone here, please put your information in chat. If you want to connect with someone, please put your information here in chat, in the chat room, okay? I'll put mine there too. All right. Is there anyone that needs help with a project that you're working on?
Daryl.
Who was that?
Russell.
Russell. Okay, Russell. Oh, Russell, yeah. Go ahead.
Yeah, I've got a 50-unit apartment building in Milton, Florida, and I'm currently raising $1.28 million for it to get it closed. And we already got the team in place, boots on the ground. It's just south of Whiting Naval Base, and the 2 of the guys are already stationed there, and they're going to be basically overseeing the rehabs and doing the work on there with the property management. Property management's already lined up, loans in place, just doing the capital raise is all.
Okay, sounds good.
And Daryl, Dennis
Yes.
here. We have an investment opportunity in Mississippi. It's been a project I've been involved with for more than a year. Finally, have got it under contract. And we're looking for people who may want to participate on the limited partnership side. So I'll leave my contact information in the comments or chat section, and whoever might be interested in looking into it, please give me a call or contact me.
All right, great. That's fantastic. The one question, when you registered for this particular mastermind group, it asked you, what did it ask you? How did you hear about this group, or how did you find this group? I think maybe actually who referred you. The reason for that is because if you were referred to this group or know someone in this group, we can discuss deals in this group. That's 506Bs, because we all know each other, or through someone we know each other. So with that being said, we got that out the way. For the two deals for Dennis and Russell, what I would like, get your packet together and let's do a little presentation on that, so we could get some money raised for these particular deals. All right. Let me see.
Darryl, I have a question.
Go ahead.
About your Texas property, the 10 unit.
Yeah.
Are you doing debt on that, like a debt loan?
Yeah.
All right. If you need a conditional loan approval, just reach out. I can at least give you a comp on it, or a LOI on it.
Sounds good.
All
okay.
right.
Sounds good. Once I finish writing up that deal, everyone, I will be presenting the underwrite right here, so that you could plug holes or shoot holes, get your bow and arrow out, or whatever you want to do, so we can answer questions concerning that deal. All right. Because we're about taking stuff down in here. We're not about letting things sit around. All right. And if you're interested, let me know. It's in Lamarck, Texas, 23 minutes from Galveston, 48 minutes from Houston. Okay. So without further ado, we're going to discuss what's going to happen today. Today, we have a guest. His name is Robert Beardsley. Robert Beardsley oversees an acquisition and capital markets for Lone Star Capital, and has identified, negotiated, and structured over $100 million of multifamily real estate transactions. He has evaluated thousands of opportunities using proprietary underwriting models. He has a popular newsletter read by hundreds of real estate professionals, and has published over 50 articles about underwriting, deal structures, and capital markets. Robert also helps run Green Oaks Capital, his family's real estate investment and advisory firm. Robert grew up in Silicon Valley and currently lives in New York City, where he enjoys reading, nonfiction, traveling, working out, meditating, playing golf, and piano. Robert Beardsley, I would like to say thank you and welcome you to the Commercial Multifamily Masterminds, to the group. Thank you, sir, for coming.
Thank you for having me. What a great group.
Fantastic. So let's just jump right into this, because I know there's a lot of people here. A lot of us use your model. So we would just like, you could go ahead and share your screen and let's just walk through a model on and answer some questions at the end.
Perfect. Absolutely. So let me just get the chat open as well, so that I can look at the chat while we talk here. So it sounds like we've got a pretty experienced group here. So I will, I'd love for this to be as interactive as possible, so that I'm not just walking through the basics and everyone's way past that. So would want to be able to provide the most value possible to the group. So just keep that in mind as I get started. But to start out, this is our website, Lone Star Capital. If you are not familiar with us or you don't have a copy of our underwriting model, I recommend you check it out. You can click this link at the top. Free download of the model. This is my book that came out last May. That goes very well hand in hand with the model, but you don't need the book. You can get the model for free. Follow along today. We'll be using the model today to look at some examples and whatnot. Daryl asked me to prepare an example deal so we can look at that and kind of just see how the numbers, how you would take the numbers from an OM and the raw financials and then put it into the actual model itself. So that's that. So before I get started, let me know in the chat or just by unmuting yourself, and so I can get a better understanding of how where everyone's at and what everyone wants to learn today. Do we want to go start from the basics?
Yeah, let's we do, this group here is well-rounded. We have new investors, seasoned investors. So if we can really just take it from what you're about to do with the OM, the T12 and the rent roll, that way it could give them some it can enlighten them on what is required to put into that model.
Okay, great. So I'll try to do that as quickly as possible so that we can get to some more fun and exciting stuff.
Sounds good.
So here we have just an offering memorandum, an older one for an example deal in Houston, and this is what we'll use. I've got let's see here. I've got a completed model of this deal here, kind of like we'll use it as a cheat sheet, but I'm also going to just open up a brand new blank model so you can kind of see from start to finish what it looks like. So this is just the blank model, right? Nothing is really filled in. There's some examples or some kind of placeholders for some things, but we're really starting from scratch. So I'm going to start running through it and then also talk to each individual line item. And, as questions come up, we can go deeper and talk about, if there's any questions or a certain aspect of the model. So first off, I'd like to put the name of the deal, Woodstone Manor, plug in the purchase price. Let me just remind myself, looks like, let's just say they want 10.5 for the deal. So I'll put 10.5 in for the purchase price and then 10.5 for the pricing guidance. So it's always good to know what the pricing guidance is before you spend a lot of time on the deal. That's my opinion. I just hate to not know what the asking price is, do a ton of work, come up with a number, and then reach back out and find out that the asking price is way off. So that's me. I like to know what I'm working with, and that way I can quickly discard a deal, because that's the most, not the most important thing, but that's an important part about underwriting, is how time consuming it is. And if you can find ways to sharpen your process so that you could save yourself time, because we all know that we need to look at 100 deals before we can find the next one that's a good fit. So the faster you can get through those 100 deals, and that's both through having relationships and having access to deal flow, and also through having the capabilities to actually screen that deal flow and underwrite it and get those LOIs out. So that's why we keep the pricing guidance here, because we want to know, are we 5% off the asking price? Are we 10% off the asking price? Can we pay more than the asking price? So it's just good to have that understanding. So Jim asks about how long does it take to underwrite a deal start to finish? So I'd say for me, if I'm doing a quick preliminary, I can do it in less than 30 minutes. And that's just getting all the numbers in place, kind of putting some approximate numbers in. Definitely doesn't give me enough time to fully vet the deal and do rent comps, right? And rent comps are certainly time consuming to have to look at comps and have to make sure that you're comparing apples to apples, call the properties. So that's very time consuming. But if you don't do that and you just kind of put some placeholder rents, like Daryl mentioned, he was kind of going off what the broker said on the rents as an example. If the broker's telling you, oh, the rents can be increased by $100, you might start with that in your model And if the deal doesn't pencil with what the broker's telling you, then it's probably not worth digging in, because it's usually unlikely for the reality to exceed the broker expectation. So that's, if you kind of want to do a back of the napkin, you just kind of plug in, the numbers from the T12, plug in the numbers from the rent roll, get some of the broker assumptions in there. And then if you're 10% off the price, there's no real reason to spend more time there. So yeah, those are my thoughts there. So let me just get back to where I need to be. Okay. So this deal, for example, is a deal that you see pretty commonly these days. So it's a 36% unrenovated and 64% partially renovated. And they're telling you that there's a $105 rent gap with the comps. And so what it sounds like is they're pitching not just that there's 36% unrenovated and 64% renovated. They're also saying that the 64% that are renovated are partially renovated, implying that they're pitching you a further value add, that you can add some more, whatever it is, a lighting package, a tech package, or whatever it is, into those partials to get them even higher, which may or may not be the case. But my initial reaction, and it's been probably a couple years since I've looked at this deal, my initial reaction is probably that those 64% partially renovated units are probably actually the top of the market. Maybe there's a little bit of juice, but really the juice in this deal is taking those 36% unrenovated units and bringing them up to the partial. But we'll see. So this deal is 144 units, 1983 vintage, and it's 93.8% occupied as of the May 2019 rent roll. So we can take in some of those numbers. 1983 vintage, the vacancy is about 6%, and the address is here, so I can bring that over here as well. Nope, didn't copy over. So the address, what we use the address for is, obviously we want to know where the property is, but the first thing that we do, aside from looking at the numbers, because there's obviously a quantitative analysis, and this is very quantitative. We're all in the numbers, but then a lot of underwriting and a lot about these deals is qualitative. How do you factor into this, spreadsheet, the quality of the schools nearby? How do you factor in, the fact that Amazon is building a new warehouse? So there are qualitative assumptions or qualitative things that you actually do need to take into account. And that's where some of the more of the art comes into play, where you need to not just be staring at rents and expenses, and you need to actually think a little bit more about some other factors. So the address, one of the first things we do is we actually open up Justice Map, and we pop it into Justice Map, and then we can quickly see the income demographics for the area. And with Justice Map, you can actually zoom in to the block level. So you can go to the, let me just put in justicemap.org. So then you can look at the census tract, and you can see that piece, and then you can zoom into the block, and then you can actually get really narrow into the neighborhood. So that's something that we do because, we don't like to just throw away deals if they don't pass on one single metric. But at the end of the day, if you're looking at a deal and there's $20,000 median incomes for the area, unless that's what you're looking for, that could just be a no-go zone if you don't know what you're doing, or if that's not what you're specifically looking for. So it's always good to just do that and get that initial check out of the way. No, I'm not trying to show it, Jim, but I just popped the link in. Also, somebody asked for the website link. Let me see here. So
they want the website link to your site? Because I could put that in. Don't worry.
Yeah. Okay, cool.
Yeah, and don't worry. I'll send I'll send everything out, links and links to the site and everything. Everyone, I will send it out to you. That's a promise.
So David says, okay, so I need to get this 10-250 Lands End. So David says you can't get the block. So I just want to show how that works. So here we're going to go 10250 Lands End Drive, Houston. I'm going to click on income and advanced. Not sure why it's taking so long. 10250 Lands End Drive.
It does that when Zoom is on. I notice things slow down a little bit.
Yeah, that makes sense. So yeah, if you want to see the block, assuming it's working, right, you'd have income here. They would show you the tract, and then you'd go to here, income block, and then it would show you the block. So let's see here. So as an example, not sure why it's not pulling up the specific area that we want, but here I can click on one of these and you can see the block, and you can see how precise the block can be. You know, here's Woodstone Manor actually. And obviously this is super slow, but yeah, you can get pretty close here. So you can see like each individual chunk. So anyway, so that's, like I said, that's something that we do. You know, one of the first things we do just as another pre-screener. So, and then we can put some of those metrics here because, you know, the tract and the block, we want to know the income and all that stuff, population growth. So now we're going to go back to the OM and we're going to just get a little bit more information about the deal. So we know there's 52 unrenovated units. So I'm going to want to take that, I'm going to want to take that information and pop it right here, 52. As to how many units we're going to renovate. Maybe we'll choose to renovate the partially renovated units later, but for now, I'm just going to assume that we're going to want to spend, as just a rough number, $5,000 per unit on the 52 unrenovated units. My model has a pre-built or just kind of like a placeholder for stabilization timeline, and 52 units can definitely get done in 9 months. But you know, that's on you to change. If you want to be more aggressive and you want to say 6 months, if you want to be more conservative and say 12 months, you know, that's obviously up to you. You should override that initial placeholder. That placeholder is not, you know, the end all be all. So I'm going to use 12 months just to be conservative. And that's very typical.
What does that 5,000, what are you including in that 5,000?
So a standard turn. So we can look at the example picture here. I'll blow it up. So we've got, I mean, this unrenovated unit looks pretty solid actually. It just has dated countertops, and you know, in my opinion, not the most attractive cabinets, but you could just paint them and you could probably update the hardware. So typically a $5,000 turn on a property like this would get you paint, new flooring, and countertops and new appliances. So judging from this picture, you could go for like a programmatic value add where you just come in and do this whole deal right here. And you know, looks like they've got stainless steel appliances. So this would probably be pushing it for 5,000, but I don't see, I mean, it looks like the surfaces are Formica. It doesn't look like a hard surface. So you probably actually could do this for 5,000 because all they did is paint the cabinets, new appliances, and new countertop, and they maybe just painted it, and probably new flooring. So that would be 5,000.
Does that do you do it while the people are in there, or do you wait till they move out?
So typically what you do is you wait for their lease to expire, and then the strategy might be, let's just say that the upgraded unit, the classic unit is, let's just say $700 and the upgraded unit is $800. When their lease is up, you may want to just, you know, raise the rent up to $750 or $800, and that will either make them make the decision of either staying and paying the increased rent, or leaving. And then once the unit is vacant because they left, then you can actually go in and do this renovation. And then you can put the unit back on the market and lease it up at your higher renovated rent. So here we have a unit mix. So a consolidated unit mix, and we'll work off the consolidated unit mix just to save time. But obviously you can look at the full rent roll to look at all the units and their details, and you can put on some filters and make some analysis there. But for now, we're just going to look at this quick consolidated unit mix. And so what I will do actually is I will combine the screens so you can see, and we'll just copy and paste the information over into our own unit mix so that we can start making some calculations with these numbers. And so we've got studio, and there's 48 units. The average square footage is 468. Market rent, they've got 640. And then the renovated rent will probably have to do, obviously that's where you have to do a lot of homework. You've got to figure out how you want to derive those pro forma rents. Do you want to do, I mean, you need to do rent comps, and you need to identify the appropriate comps for this property. And also, depending on your business plan, your business plan might be to renovate a substantial, do a substantial renovation and pursue higher rents, or you might just do a more modest renovation and pursue just a smaller rent increase. So that varies on your business plan and is very, really important to have right. So again, I'm just copying this over from the OM, and then I will later reference comps or the rent roll to back up these assumptions. But right now we're just getting the model set up so that we can get an initial output.
Robert, what if my current rent is below the market?
So if your current rent is below the market, so there's different ways that you can approach that. So right now what we're doing, and not to confuse anybody, when we're plugging in the market rent, that's not the market rent for the market, it's the market rent for the property itself. So if the property has market rents, all properties have their own market rents, and then you adjust if your actual lease rents are below the market, then you would adjust for that with loss to lease. So we'll show that in just a second here with loss to lease, and I'll explain how that works. But I'll quickly touch on it. So let's just say that you have a 2-bedroom unit and the market rent is $1,010. What that means is, in ordinary course of business, you should be able to lease out your 2-bedroom units at $1,010. But let's just say that, there's many examples. Let's say your leasing agent had a bad day, or let's say a new prospective resident came in and negotiated really hard and they got a $950 lease. All right. So that $60 gap would be represented as a loss to lease, because that's showing the difference between what your actual signed rent is versus where you should be getting your rents for the market. Another example of loss to lease would be rent growth. So if you sign a lease in January for $900, but then the market's on fire and rents are going up in the market, all the properties rents are going up, and now your market rents are $1,000. Well, you can't go back to that unit that you leased in January and raise that rent because it's a year-long lease. So you're going to have that loss to lease represented, because because the market's grown, that $900 unit can actually be released when it's time for $1,000. So that would be your loss to lease. So that's how you deal with below market rents. Well, one of the ways. Another way to do that, it would be to ignore loss to lease completely, and then instead of having market rents here, you could just have, I've got to unlock the sheet, but you just put current rent, and then you just plug in current rents here instead, and you could really do away with loss to lease. But loss to lease is better because it tells you more about the property and it allows the model to be more flexible. So you'll see that in just a second. So now that we've got the initial unit mix minus the pro forma, what I want to do now is actually pull up the rent roll, and we can kind of see more about what I'm talking about. And then we'll look at the T12, and then that'll come together with the loss to lease. And I think that will be a good place if this ever loads. It's crazy how slow this is. So, all right, this is actually going to be kind of a nightmare to deal with, but we'll try our best. So, ideally, you get an Excel rent roll, and it's just nice, easy. All units have their own row, and then you can put filters on the columns, and you can easily manipulate the data. This is not one of those rent rolls because we've got things like this in the middle to clean up and whatnot. So we'll just kind of scan with our eyes. So what I'll look at here is I'm looking at the square footage. So this is a 1033. So that's the 2-bedroom. It's the B2. And I can look at the market rent is 1055. The lease rent is 1115. So that tells me that this is one of the renovated units. Does that make sense? It's there's different ways to treat it, but here they actually are having a lease rent that is above the market rent, which can also be viewed as a gain to lease. Another way to do that would be to just raise your market rents to the renovated, and then you just have a big loss to lease showing that offset. So there's lots of different ways to do it. So if we look at another unit, this is 1085, again above the market rent, but not quite as high as the 1115. We've got 1120, and we've got, let's just see. So if I'm just scanning, it looks like 1120 is the highest. So if I believe that's a a legitimate rent and essentially an in-place comp, then I would take this and I would say, all right, 1120 is my goal to bring up all the 2 bedrooms, assuming that I spend the renovation dollars and get it there. That should be my goal there. So Scott asked a question about the 2 beds are under $1 a foot, and the studios and ones are much higher. Would it be better to convert the 2s to studios? If possible, yes. The difficulty are the kitchens. Having the space to throw up another kitchen is typically the prohibitive challenge. It's cost prohibitive and space prohibitive. It's rare when you can actually pull that off. A 2x2 is maybe more possible, but a 3-bedroom you can convert to 2 1-bedrooms actually, because you still need that living room space, that extra kitchen space. So it's not quite as easy as you would think sometimes, but it's a good way to think, because that is an opportunity, if possible, to create a whole ton of value, especially if the market isn't seeing it that way. If you have a unique perspective on the deal, then you can potentially create a lot of value. So that's where we found from the rent roll, we found the pro forma here on the 2 bedrooms. So let's keep looking, and we'll look at some other units. So now we've got the A1, and the A1 looks like, based on the square footage, are the studios. So they've got 675 on the market, and we'll just look to see if there's any units that are leasing for more. So we've got 685, 695, 723. So we'll just say 723 is the top. So I'll plug that in here. And now we're hunting for, also, if you notice, there's A1, which is the floor plan type, and then A1R. So they're indicating that this is a renovated unit. So we could also, just focus on the R's, of course. So here we've got the A2. And let's just, I don't want to spend too much time, but let's just say that 880 is the top here. So then I'll plug that in here, 880. So now what we did is basically we used in-place rent comps. We looked at the renovated examples at the property to derive our pro forma rent. So, and this is a great way to go. And it's a great defensible strategy. You're looking at, hey, these are proven renovations at the property, right? Which is your best comp. And all I'm going to do is renovate and bring the units up to the rest of the, to the premium finish. But there are 2 things about that still, though. Number one, you, at the end of the day, want to still do rent comps to support those pro forma rents based on comparables in the market, because a lot of times what sellers will do is they'll buy a property. Let's say it's a 100-unit property. They'll renovate 10 units, and they will go all out on those 10 units. They'll get the rent as high as possible for those units, and then they'll sell the property as a value add and say, look, you can raise the whole property to that level, which may or may not be true. But you just need to be careful, because theoretically, if you sit there on the market long enough at 1,200 for the 2 bedrooms, you will find a tenant and you will lease it out, but it's going to take a long time, and it's not adequately reflective of the market rent. So you just want to be careful and make sure that you could support it both inside and outside the property. Number 2 point about this strategy is the fact that because it's fairly simple to understand and justify, you have to understand that all the buyers that you're competing against to buy this property are on the same page as you. They understand the value. And so they're all going to be underwriting to those same pro forma rents, and there's no secret. And so there's essentially increased competition and decreased risk premium or return premium in the opportunity, because everybody knows it and everybody's pricing the deal accordingly. So
When
now
you
we've got
when you price the deal, do you include the renovation price? When you ask people to invest, do you include that renovation cost?
when you say include the renovation cost, are you talking? So you're talking about the capital expenditures budget?
I'm a newbie. I just want to know, like, if you're presenting it to people, are you putting that in there, or because that you're trying to raise money to buy it, but then plus you got to renovate.
That's right. So there's 2 main ways to structure the deal. So, for example, this deal, we're going to assume that we're going to buy the property with permanent debt or agency financing, and the lender's going to give us, let's say, 75 or 80% loan to value. So they'll lend 80% of the purchase price. So that's how much debt we're going to get from the lender. Then, like you said, we still need, let's say, $1 million for a renovation budget. That money has to come out of the equity. The lender's not going to provide it. So that has to be sourced from the equity side of the balance sheet. So that's you have to raise capital, and not only do you have to raise capital for the down payment, you have to raise capital for the closing costs and your renovations budget.
Thank you.
Okay, absolutely. So now that we've got the unit mix in there, we're going to open up the T12, and it says the file is corrupt, but we'll open it anyway. So this is a very standard looking T12. It's always good. As you look at more of these, you'll get more familiar, and you'll get a better eye at looking at each individual months. And you want to look at trends. You want to see, okay, is the income trending up or down? Was there a single month where the utility bill was really high? And you just want to start picking out oddities in the T12. But for now, what we'll do is we'll just focus on the total column. So here we have the gross potential rent, which is set by the market rent. So that's this gross potential rent is simply just taking all of the units and multiplying them by their market rent, and then that's the total. So basically, if you had 12 months of fully occupied, fully paying units, then you would collect 1,369,000. But of course, we all know that's not the case, and that's why we have all these, income loss items and offsets. So to start, what I do is I look at the net gross rent here of 1367, and I will go like this: 1367,663. Okay, and then I will go back to the model, and I will see what our gross potential rent here is as calculated by the unit mix here. So what the unit mix is doing, it's taking the number of units, multiplying it by the market rent, and that's getting us this total of 1353. But here I have, based on the T12, it's telling me that the net potential rent, which is the actual signed leases, are 1367,663. So we actually have a gain to lease. And what I'll do is I'll actually calculate that by going like this. And that's one too many numbers. So it's very close, but it looks like 14,350. So I'm actually going to have a positive, not loss to lease, but gain to lease. And that gets us to our 13,670, which is in the T12. So you see how we use the loss to lease to offset the numbers that we put in here to get to get the accurate, precise calculation of the net potential rent. And the net potential rent, again, is what you actually have signed leases for. Again, that's not collected rent because there's delinquencies, there's discounts and whatnot, and vacancy, of course. But this is our net potential. So that's why I tell people that you don't have to stress out and get these numbers exactly right if you use the tool of loss to lease and the other tools here in your income lines to get it right. So let's keep going. So we've got vacancy loss. We could just quickly copy that over. That's 44,000. So I'll just pop that in. And then non-revenue units. So non-revenue units, if you're not familiar, those can be things like units that you're using as storage instead of renting them out. They can be units that are model units. So they're staged and furnished to show prospective residents an example unit. And non-revenue units could also be things that are classified at, like, for example, employee units. So if you're giving an employee a free unit, that could be either a concession or a non-revenue unit. But basically, we roll up these concessions and non-revenue units, so these three lines, into $18,000, and we just pop that in here. And then the last one is bad debt. So you could see they have bad debt and then bad debt collected. So this is a little odd, and you'd want to learn more about what's going on here, because they actually are showing a positive number for bad debt, which is a great thing, but is that the real thing? So because typically what you have is you'll have write-offs of, let's just say, $30,000, and then they'll send those uncollected rents to collection agencies, and then those collection agencies will try to collect the rent, and then you typically get a few $1,000s they end up collecting from there. But to actually have a positive here in the end, it doesn't really make any sense. So for now, we'll just leave this at 0. We'll just assume that it's a great property and the tenants are amazing. So Kenneth asks if there's a large concession, such as 2 months free rent on a 12-month lease, is the lease rent still an accurate reflection of the market? I mean, the simple answer would be the lease rent factoring in the concession would be an accurate reflection of the market, but otherwise I would say no. But it's really just based on accounting and how you want to look at the numbers. Same thing as having market rents and loss to lease. I could have put market rents here that were very high and then offset it by loss to lease, but at some point you have to ask the question, is this realistic? So sometimes what we see is a broker or seller will bring us a deal and they set the market rents very high, and our loss to lease will end up being over 8% or 10%. And then at that point, we might just throw away those market rents and say, we don't trust those. We don't even want to look at those. And then what we'll do is we'll actually underwrite using the in-place rents based on the signed leases. And again, I think with the concession, you would just, if they are giving 2 months free away, you would just have to put that into this line. In my opinion, I think that would be the better way to go, because it's just a more accurate reflection of what's going on. They're signing leases here, but they're giving a concession there, and that you're ending up in the same place. So
what
we're almost
the stabilized numbers coming in?
Sorry, could you speak up?
In your template, how are the stabilized numbers coming in? If you go back to your template.
These numbers.
Yep.
So the stabilized is your pro forma, and assuming we have the filled out numbers, which we're pretty much there, right? That in terms of getting these stabilized inputs in, we take care of it over here as percentages. So we think of things as percentages.
Right. So for the purpose of time, let's let Robert go through the steps because there's some questions that's coming in sort of ahead of the game. So let Robert go through the steps, and then let's answer the questions at the back end. How, if we could do that, because we're gonna be pressed up for time and may not make it through.
Yeah, I'll speed up here as well. I'm going a little slow. So I think basically at this point, you see the process. You've got to go through the whole T12 line by line. For example, we've got the utility income or RUBS, ratio utility billing system. So the tenants are being billed back for water, sewer, trash, pest, and that's 64,000. And then there's other income like laundry, vending machines, and then application fees and all that. So that's about 71,000 for the other income and 64,000 for the RUBS. And at this point we've completed the actual total income side, and then we would do the same thing for the expense side on the T12. We would just have to factor all that in as well. And then once we know, it's helpful to know the T12 numbers, but again, we can't just live by what the seller is running the property at. If they're running payroll at 50,000, but we think that the market truly needs, or this property truly needs 100,000, then that's that's what you have to do. It's not fair. So sellers will obviously want to show as trim of expenses as possible because they want you to underwrite to a higher cap rate. That's why we all see deals in the market that people are advertising and they say, oh, it's an 8 cap. Problem is, if you start underwriting it and you plug in all of your expenses, not the seller's expenses, that 8 cap will become a 5 cap very quickly. So that's how we go. And I think what I'm going to do here is essentially just skip ahead to the completed model. This is actually a slightly older version of the model from about a year and a half ago, but you can see still pretty much the same situation. So what we had is, we filled out the income, and as you can see, we got to 1440, and in our model that we just worked in, we got to 1440 again. So we correctly copied from the T12, nothing too fancy. And then the expenses came in from the T12. And then on the stabilized side, I'll just quickly explain, how we come up with these different assumptions. So, for example, if we think the vacancy rate that's appropriate for this property based on the comps, based on its previous performance, then we would plug in 5% here. Loss to lease at 2%. We keep that pretty standard. Concessions and bad debt. Of course, you want to work with your property manager that knows the market, knows what these general percentages are. And that way you can get to your stabilized or pro forma revenue assumptions. Similarly, on the expense side, we think in terms of not percentages, but in terms of per unit costs. So we know that payroll typically costs something like $1,200 to $1,400 per unit, and so on. And so we just have these general rules of thumb for the line items, and you want to work with your local property manager, or if you have a portfolio that you're managing, you want to keep track of that data so that as you're underwriting that you're using market expenses, and you never want to miss or not factor in fully the expenses, because that can get you into trouble, especially when you're talking about smaller properties where every $1,000 really, really counts. So now at this point, we've got the numbers plugged in. We've got the full setup from revenue to expenses. And then now you've got your NOI. And then what comes next are some more of the below the line items, such as debt. And for example, this deal, what we'll do is we'll talk about what debt is available today, right? So we'll say that you can probably get 80% agency loan at about 3.25% today on a fixed basis. You'll get 3 years of interest only payments. The amortization is 30 years. And so that right there is simply enough that makes up your debt assumptions. And that's pretty much all you need to worry about over the course of your hold period. And in this case, I'll skip down here. Your hold period is 5 years. The big piece that we haven't touched on yet is the exit cap rate. And that's pretty much, what we'll have time for. And then we'll open up to questions. We can dive into more specific parts of the model, or just take general questions. But so the exit cap rate is very crucial and a very important input because it determines so much of the return. So, and what the exit cap rate does is it takes the income, your NOI that you have in your year that you want to sell. So in this case, we want to sell at the end of year 5. So it'll take our year 5 NOI and it'll divide it by a cap rate that will derive our value that we are going to project to sell at. And obviously with value add deals, especially, the price at which you sell determines so much of your return, right? The cash flow ongoing is nice, but you have to make sure that you sell for a lot more than what you paid in order to really hit your target returns. And so we spend a lot of time focusing on terminal cap rates and making sure that they're not too aggressive. But at the same time, if they're too conservative, like in this case, 6.5 cap, it's probably too conservative given this deal profile, the location, the market. And funny enough, this was a year and a half ago, and cap rates have definitely compressed in that year and a half as interest rates have come down and stimulus and whatnot. So it's just something to be aware of and understand that you need to really know the market. And this gets easier, obviously, as you do more and you know the market, you talk to brokers, you talk to owners, and you can get a better sense of, well, if I wanted to buy this property in 5 years or this property today in its renovated state after I'm done, what cap rate would I have to pay for it? And because that's the issue that trip a lot of people up when they're talking about value add deals is they'll buy the deal at a 4 cap because it's a value add, knowing that they can raise the NOI and raise the cap rate to 6. And so they think, well, they can sell for a 5 cap because they bought it at a 4. But the problem is what you're selling is different from what you're buying. You're not selling a value add deal when you go to sell this property. You fully renovated it. So now you're selling a yield. You're selling a stabilized property with no upside or maybe a little bit of upside. So you need to adjust the cap rate accordingly, knowing that buyers are going to want a better yield if there's no upside. So that's why even if you do buy a value add deal at a 4 cap, you are likely still going to need to project to exit to a 6 cap as an example. So that'd be a 6 cap here. So hopefully that made sense. I know we kind of jumped pretty quickly over to the end, but basically once you've got the numbers plugged in, you can look at the summary tab and it shows you what we've got going on. This deal looks really good for whatever reason, 30% return. That's not typically how deals look. So either so actually as an exercise, it'll be helpful for us to look at this deal and understand, why does this deal look unrealistically good? I think that's actually a helpful thing. And I didn't pre-plan this at all. I'm just looking at the numbers now. So I'll look at it with you.
Fantastic.
And,
Fantastic. Thank you.
So let's just look at this really quickly. So you could see that we're buying this deal at a 6.3 cap. And that right there is not a red flag, but that shows you the unrealisticness of this deal. Like I mentioned, for a value add deal these days, you're not going to be able to get it for you're not going to get it for a 6.3 cap. The best you could get it for is maybe 5.25. So that right there tells you why this deal looks so good. So if we just fix that, right? And again, we're just playing with numbers. It's just hypothetical at this point. So if I just increase the price to like 11.5, now to 5.5, the deal still looks amazing. So I'm going to take it up to 12 just to try to reflect it of what typical deals look like. So now we've got a 5.25, and now this deal looks great. 15% net return to investors. But see, as you can see, once we bring that going in cap rate more in line with where the market's today, you're starting to get more realistic returns. So, and the cash flows are pretty healthy because again, we're financing at 3.25, buying at 5.25. So you're getting a great spread on your cap rate versus your debt to produce good cash flows. But one thing to notice here is that when amortization kicks in, meaning the interest only period of the initial 3 years runs out, then the cash flows drop substantially. And so for myself and my investors, amortizing and having 5.7% cash flow is unacceptable in normal circumstances. So I would pay very close attention to that, and I would probably want to restructure this deal either with lower price or different debt structure, to make sure that I'm meeting my goals. But yeah, so that's so that's how we get to this point in obviously a really quick way, and then we can analyze the numbers and look at the returns, and you should as you look at deals more, everyone here should have a a return target in their mind or actually on a spreadsheet that tells them what return they should be seeking based on the deal profile. So if I'm taking X amount of risk, should I want a 15%, excuse me, 15% return, 16% return, whatever the case is. And then all you have to do is adjust your purchase price to meet that return goal. And then that's your feedback to the broker. That's your offer price. And, nobody can kind of push you around because you're not going to move off your target return price. If that's your target return, that's the price. And there's nothing you can really do about it. So it's a good way to kind of stand behind your numbers. And, originally when I first started in this business, I kind of felt that like my underwriting was something not necessarily secret, but just personal. But then what I realized is, the more you share your underwriting, the more you learn. And I loved what Daryl was saying before about, get your bow and arrow ready. We're going to poke holes. I mean, that's the best way to learn. That's the best way to actually vet out deals and know that you have something special on your hands. And so what we do, and one way that I learned a lot was actually just presenting my underwriting to brokers that were actually selling me the deal. And they're very good competition because they're on the other end trying to negotiate and push you to come up with a higher price. So if you actually sit down and walk through your underwriting with a broker line by line, and you say, oh, well, I'm using a 5% vacancy rate. They say, oh, well, could you push it to 4, right? Knowing that if you make your numbers better, then you can afford to pay a higher price. So that's a good back and forth to experience, to just, see a different view and make sure you're not missing anything as well. But yeah, that's, hopefully I didn't take up too much time, and hopefully there's time for some questions, and hopefully you guys got some value.
Yeah, we got time for questions because I had blocked out for an hour and a half. So I knew it was going to take time, but I just didn't want it to take. I didn't want it to take the time away from what needed to be inputted into the underwriting. But I do want to ask you a question. Since we have COVID, and a lot of investors are underwriting with a 1 year 1 year P&I, P&I that has to be held by Fannie or Freddie, but we're also holding where 1 year we may hold off on doing renovations until the 13th month. I know in one of your videos you were showing how to take the can you go back to your input tab? Okay, so you were showing how to take the operating capital and to subtract it. I think it was from the exit budget, and in order to show that the money is sitting there. Can you just explain that for us?
Absolutely. So this is, like you mentioned, it's a very specific topic to what we're going through right now. The COVID reserves that were popular, that were introduced by Fannie and Freddie back in March of last year. So the way that we factor those in is we can go like this. It's pretty simple actually, but COVID reserve, right? Like Daryl mentioned, the lender's going to want 12 months. Typically it can be 6 to 18 months, but let's just say 12 months of principal and interest payments that they're actually going to hold back from funding at closing, because they want to have those extra reserve funds sitting there for certainty that if things operationally deteriorate at the property level due to COVID, they'll have that reserve fund there to cover mortgage payments and keep the deal safe. So the way that we do that is I'll just set that COVID reserve, and I'll go and grab 12 months of principal and interest here, and we can just grab that from year 10. So that's in year 10 we're amortizing, and so that 501,000, that's principal and interest. So now we've got our COVID reserve of 501,000 here, and like Daryl mentioned, it'll be released in 12 months. So what we can do is I can go like this, COVID, hold on, let me unlock. COVID reserve released. And I will just set that equal to the negative of this. So now we're just offsetting it. We're just returning that back here in year 2. And you can see that what happens is the cash on cash jumps in year 2 to 27%. And so this isn't exactly correct, because that money that's being released is not actually cash flow. It's a return of capital. But this is just the simplest and easiest way that we have found to just quickly incorporate this into our numbers and still be accurate. So so that's the simple way to do it. But the other way to do it is to actually, instead of returning that money, that 500,000, is you can use that money for renovations. And, you know, instead of having a 15-month stabilization period, we could do a 24-month stabilization period and basically slow it down. But we don't need, you know, the renovation dollars all up front. Maybe we only need 200,000 for the first 12 months. And then when we get that $500,000 that the lender releases in 12 months, and then we go and finish out our renovation. And so, you know, that I need to see that this budget is, so in total, the budget's only about 500,000. So what I could basically do here is I could just, you know, eliminate the budget. So now, instead of actually raising those capital expenditure budget from the equity investors, you can look at it differently. We're actually raising the COVID reserve amount. And then when that reserve is released, then we're doing the CapEx. So it's really the same numbers. I mean, obviously money's fungible, but that's a way to raise less money than you would need to if you needed to both raise your CapEx budget in full and raise the COVID reserve in full. It becomes a lot more equity to raise than you otherwise would need to. So these COVID reserves are going away. They're not here forever, but they certainly have affected many deals in the last, you know, almost year. Let me answer some questions quick. I've got some good ones coming in here. So first question is, can you do a refi in your template? Yes, absolutely. You know, the way that you would do a refi is you would just map out how long you want to be in the first loan. So let's just say we want to be in the first loan for 24 months. And then that would mean in month 25, we would jump over to the refi loan assumptions. And so we'd have, let's say, 3.5% interest rate, another fresh 3 years of IO, and then we have to determine the cap rate at which we want to do the refi, which is essentially what value do you want to refi at. So yeah, it's just that easy. That would get you a refi there. Annual rent and expense increases are right here. So if you want to, you know, set these to whatever you want, 2 and 2, nice and conservative, just every year, basically inflation is, you know, happening to rent and expenses. That's how you do that. That's just happening throughout the whole period. The last one is the stabilization assumption, assuming we start upgrading on month 1? Yes. So it just creates a linear formula of, you know, let's say we're raising rents by $120 over 12 months. It'll just basically every month add $10 per unit to your gross potential rent as you keep increasing. So you want to make sure, you know, you want to understand that formula or tweak that formula, whatever works for you, based on your deal's business plan.
Hi, Robert. This is Gene. I have a question. Can you hear me?
Yeah, I can hear you.
Sorry about that. I'm outdoors. What is the cash on cash year 1 on this example deal you're showing? Thank you for putting this together, by the way.
No problem. So let's take a look. So the year 1 cash on cash here is 9%.
Okay, 9%. So on a typical deal like this, what kind of returns are you giving your investors?
So typically, if the deal is cash flow focused, it will be I would say in the first year, hopefully 8%, and then build that up to 9%. If it's a value add deal, then cash flow is a secondary metric, and we're focusing more on total return. And especially if it's value add, we might be buying below market rent or high vacancy, and that means the year 1 cash flow could be 5%.
You're muted, Gene. You're muted.
Thank you. I didn't want you to hear the music in the back. Thank you. So you're saying if it's a value add deal, then the investor usually will get most of their money on the exit on the back end, versus if it's a cash flow deal, they'll get it each year. Because is that a fair assumption?
That's exactly right.
Okay. So so let's talk about on a cash flow deal then. So would you classify this as a value add deal or a cash flow deal?
So this is a value add deal because we're I mean, it's not a big value add. If you look at what we're doing in terms of the business plan, we're only renovating 36% of the units. And we're only raising the revenue from 1440 to 1577. It's not a huge value add. So I'd say it's kind of core plus value add. So
Okay. Thank you for explaining the distinction between value add and cash flow. Because on a cash flow deal, I would think as a general partner, you're not getting paid much at all throughout the whole process of this deal.
that's right.
So and how? Okay, so I think that's been key for me is I've been focused on cash flow. So a lot of, I guess, value add deals that were presented to me just didn't make sense because it just seemed like it was really skinny. Didn't have that much room. You know, should the market turn on you, you don't have that much room, it seems, to be able to recover. Like say more, you know, let's just say COVID turns around and second strand, more people are not able to pay because they're ill. The cash flow on that will really drop significantly, I would think.
Right. Yeah. So there's different ways to look at it, and you definitely need to be looking at your downside. And the downside analysis is different for cash flow deals and for value add deals. Because for value add deals, you're focused on the creation of value, and so you want to look at your how much value you're creating and how much value is being created relative to your loan, because your debt is a major source of your risk. Similarly, on like the cash flow side, you want to look at your break even occupancy, and like you said, if COVID comes back and it really negatively impacts a property, you want to see what it can withstand. How much reserves do we have, and what's our break even occupancy? Can we run the deal and still be profitable at 70% occupancy? And is 70% occupancy our downside scenario? Because if so, then we're okay. As long as we can survive, we'll live to fight another day. So those are the analyses you want to be doing, in addition to evaluating whether the projected cash flow is meeting your goals.
Excellent, thank you. Are most deals you're seeing are they mostly value add deals, not that many cash flow deals?
Unfortunately, yes, and that is for one main reason, which is basically even if the deal is a cash flow deal, the market is so competitive, people are going to find a way to construe that deal as a value add deal to convince themselves to pay more for the property. Because if you're buying what is really a cash flow deal, but you're telling yourself that you can raise the rents more, you can shave expenses more, then that's how you'll justify to pay more in the price. And price is very competitive today, and that's what people have to do. So pretty much every deal out there is being pitched as a value add deal. And so what you have to do is actually go and find the ones that are actually the real value add deals, because in the end, it's a very, very rare, not very, very rare, but it is rare to find the deal that is not a value add. And they're just telling you straight up, yep, this deal is not a value add. There's no meat on the bone. Just buy the cash flow. I like those deals. Whenever a deal is being marketed and it doesn't say value add on it, I get interested. I think, oh, wow, it's different.
Yeah, thank you so much. That's very enlightening. I appreciate that.
Absolutely. A question that came up a bit ago, I noticed, I think it came around twice. What does it mean in the OM where it says all cash? All that means is that you are able to buy this deal free and clear. There's no loan assumption that is burdening the property. So you can buy the deal literally all cash, or you can buy the deal with a combination of cash and debt. However you want to finance the deal, that's up to you. It's an all cash transaction. Just bring bring the full amount to the seller and they're happy.
Dennis asks, how would you hedge for increased interest rates that might come near the end of your hold period?
Very interesting. So that partially depends. So interest rate risk comes in the form of two things. Interest rate risk could be you have debt that is floating rate debt, meaning that the interest rate actually is adjustable and changes month over month, depending on an index rate such as LIBOR or SOFR. And that would be interest rate risk, because LIBOR could increase and now the debt service that you're paying every single month goes up, and that's a risk. The other interest rate risk is that your loan matures and now you have to go and refi or sell, and the interest rate environment is different than at the time at which you financed, and now there's there's uncertainty in the market. Maybe when you so maybe you had a fixed rate loan at 3%, but when you refi now it's at 4%, and that's a that changes your situation. So the best way to hedge for interest rates, number one, you want to extend your maturity out as long as possible. The longer the maturity, the lower the interest rate risk. If I'm getting a loan for 1 year, that means I'm going to be subject to maturity risk and interest rate risk in 1 year. If I get a 10-year loan and it's fixed rate interest, that means I know for a fact the interest rate that I'm paying for the next 10 years. And that's a very, you've essentially taken interest rate risk out of the deal. Obviously, in 10 years' time, when you have to refi or sell, then you have maturity risk, interest rate risk. But the idea is in 10 years' time, you should have amortized, paid down the loan, and also your rents should have increased and inflation. So you should really be in a good place, and your loan to value is low, and the risk on that debt is low. So that's number one. Number two, interest rate hedge is actually on a floating rate loan is you would have an interest rate cap, and a cap is a hedge product that lenders actually make you buy. And what it does is it sets a ceiling on your interest rate. So while your interest rate's floating, so it can go up and down depending on what the Fed says or whatever the case is, you can set a ceiling with your hedge. So if your rate cap says, I'm not going to pay any more interest, I'm capped at 5%. So you might be at 3% today and you can float up, but if you hit 5 and go above 5, then your cap protects you, and you don't pay anything more than that ceiling. So those are the two, real strategies. You've got your interest rate cap, which is a hedge product for floating rate debt, and then also longer maturity helps reduce maturity risk and interest rate risk.
I have a question. I thought it was a great idea to sell it so the buyer can still improve and make money. How can you how do you structure that?
Yeah. So I definitely agree with you. It's a great strategy. If you can find a deal that's untouched, which is very rare these days, right? Investors have picked over a lot of product. But if you can find a deal that's untouched, unrenovated, you can buy it, renovate 20% of the units as an example to prove out the business plan, and then sell it to the next buyer with meat on the bone. And what that does for you is it does a couple great things. Number one, it allows you to actually implement your business plan a lot faster. If all you have to renovate is 20% of the units rather than 100, you can be in and out of that deal much quicker. And that means that, if you want to be in and out quicker, then that's conducive to your goals. Also, you're taking less risk because you're actually spending less money on your renovation plan, and you're getting in and out. So that's in one way you could look at that as lower risk. And the big one is you get paid for it. Investors are happy to pay essentially full price as if the property were already renovated, even if it's just 20% renovated, because the market is just so hot these days. So that's really the magic of it, is you're not taking that big of you are taking a discount, but you aren't taking that big of a discount to sell something that's only 20% renovated versus 100% renovated. So that's the magic of that. And the way that you would actually model that in the spreadsheet would look like this. Let's just say, we want to renovate 20% of the units. And so let's just say that's 25 units. All right, we're going to spend 6,000 on each unit. And what I can do is I can shorten my stabilization period. I only need 6 months to prove it out, whatever the case is. I'm going to sell in 3 years because all I'm doing is kind of proving out the plan and getting out of there. And then the big thing that also you need to adjust now is the exit cap. Now, remember when I said when you are buying a value add deal, you're buying at a compressed cap rate. So similarly, if we're going to be selling a value add deal, we'd be selling at a compressed cap rate. So instead of selling the yield, which would be a 6 cap, right? That way a buyer can buy that 6 cap, finance it well and make their return on a cash flow. Instead, now we could sell this deal at a 5 cap or even less because we're selling the upside. And so that's how you would actually model that out, in my opinion.
Thank you so much. I appreciate it.
Moses asked, how would you underwrite this analysis with an equity pref position to investors?
Right. So that is a great topic. And this is an older spreadsheet of mine. So I'm going to jump to the newer one, which has the waterfall. So this waterfall here is where you would put your partnership structure together. So if you are giving your investors a preferred return, you'd factor that into here, an 8% preferred return, a 7% preferred return, whatever it is. So this would be, if you want to learn more about partnerships and the way that those are structured, you definitely want to dive into waterfalls and understand how they work and the priority of distribution, because that's how these partnerships work. Is we have the waterfall, which is distributions flowing. Excuse me 1 second, I have a delivery. All right, let's see. Okay. So yeah, you definitely want to dive into waterfalls, and I do have an hour-long video that I did for Dan's Multifamily Investor Nation Summit, walking through the waterfall and partnerships. So it's actually my most popular video on YouTube. So go check that out. And I'm actually, the next book that I'm coming out with will be more focused on debt, equity, partnerships, sourcing partners, capital. So I'm going to be diving real deep on that. So excited to be sharing that with you guys. Hopefully soon. So yeah, I don't want to spend much time, but the waterfall tab is where you would actually, give investors that pref here. And the way that works is you're essentially the first 8% return goes to investors, and you get 0 promote on that first 8%. And then above 8 up to 18, you as the sponsor get a 30% promote, which means every dollar over that 8% return that investors get, you would get 30%. And then if you want, you could have a second tier, which means above and beyond 18%, now we're splitting every dollar 50-50 with your investors and you as the manager. You're being compensated at a greater percentage for better performance, right? You give investors an 18 and now you split 50-50. So that's just one example of a waterfall or promote structure.
Fantastic. So Rob, I want to say thank you. Are there any more questions in this month?
Rasul has a question.
Okay, yeah. In this market of highly compressed cap rates and super low interest rates, what's the danger ahead when the market shifts in the other direction? How would we mitigate that from an underwriting perspective?
Yes. So this is a great description of where we are. We've got low cap rates, we've got low interest rates. So, the low interest rates are helping the low cap rate environment work. We can buy at a 5 cap, we can get debt at 3, and a 2% spread is actually very attractive. Assuming you're buying a quality property in a quality area. If you're going out in the middle of nowhere and buying a 5 cap, then that's not good. So the best way to protect from the shifts really have to do with maturity risk, like I mentioned before when we were talking about interest rate risk. So in terms of debt, you've got the 2 main risks: interest rate risk and maturity risk. In my opinion, maturity risk is much more serious than interest rate risk, because interest rates go up a bit, then your cash flow goes down a bit. But the maturity risk is where the implications of those changes really take full effect, because if interest rates are higher, cap rates are likely higher, and that means your property is worth less. And so if you are looking to sell or refi, your valuation is lower, and that that can get you into trouble, because if you have a $10 million loan on your property and your loan matures and cap rates are higher, now your property is only worth, 10 million itself, then you can't get a new loan for 10 million to pay off your existing loan. You're hung. You're stuck in your loan, and you actually have to either do a capital call to bring more equity to the table, or you're forced to sell the property for that $10 million price, and then all that money goes to just pay the lender, and then you're left with nothing. And so that is not a good situation. So you always have maturity risk, but if your loan, like I said before, is a 1-year loan, maturity risk is right in your face. You've got 12 months, and that's you've got to make things happen. You've got to make sure that the world is okay in 12 months, which it may or may not be. But if you have a loan that's 10 years or 20 years in maturity, what are the chances that in 10 years time, your property is in worse place than it is today? The reality is, assuming that you're investing into the property, managing it well, in a good market that's growing, your rents are going to be a whole lot higher than where they are today. And also, because you have a 10-year loan, you'll be, again, like I mentioned before, paying down principal. And you have, if you started at 75% LTV, you might be down to 60. And now a 60% LTV loan is pretty easy to refi because you've got a lot of equity there. You got a lot of value. The biggest example, I would say, if you wanted like a bulletproof strategy, which, there almost never is, would be a great example is a HUD loan, which the 223F loan product, which is a 35-year loan term. And it's a 35-year amortization schedule, also known as self-amortizing. So you can literally get this HUD loan, which is super cheap, but the process is very long and arduous to get. But you put that loan on, and then you don't have to worry about, you have zero maturity risk because your loan amortizes on a 35-year schedule and matures in 35 years. So you have no balloon payment. So if you hold that deal for 35 years, you will actually have paid off the loan completely and own the deal free and clear at the maturity of the loan. And again, you have no maturity risk because when the loan matures, you own the deal free and clear. There's nothing to do. So that would be the most clear example of taking maturity risk out of the equation, which is, in my opinion, the biggest risk in terms of the market shifting. If cap rates move higher on us, a lot of people that have loans maturing in the next 2 years, 3 years are going to have to, make a decision as to what they're going to do. Are they going to sell into this higher cap rate environment and potentially take a loss or not get the returns they wanted? Are they going to refi and get a loan that maybe they have to bring more equity to the table? So that's the answer there. I mean, I'm sure there's more to talk about there, but that is a great topic.
All right. Well, I tell you, Robert, thank you very much for coming to the commercial multifamily masterminds. I really appreciate it. I read your book. I've been using your model, and I know you probably got tired of me in the beginning because I think I was emailing Robert almost every day in reference to a question on the model. But I really appreciate it. He took the time to answer the questions and everything. So, Robert, I would like to have you come back at another point in time, so that we, so that our team here can show you how much we have grown if some of us using your model, and so we can show you where we are at. So, but I want to thank you very much. If anyone would, if people could get in contact with you, what would be the best way that they could get in contact with you?
Yeah, so the best way to get in contact with me or learn more about what we do is to head over to our website, lscre.com. You can learn more about our value add acquisition strategy, about our capital markets advisory services. And like I said, at the beginning, you can download our model for free, check out my book, and, of course, contact me, about anything. So that's all I have.
All right. Well, thank you very much. And I really appreciate it. And listen, everyone, let's give Robert a big round of applause. Take yourself off mic and let's give a round of applause. All right, all right, all right. Thank you. So listen, everyone, I got to run. It's 12:33. I kept you 3 minutes past my promise time. I want to thank Alicia for being my co-host. She was watching everything and bringing the people in. Thank you very much. So if anyone have any questions for me, oh yeah, I will send out a copy of the recording to everyone. Robert, do you want a copy?
Sure. Or if you just post it on YouTube, I'll have my marketer download it off YouTube. But either way.
Okay, I'll send you the link. Don't worry. So, okay then. So everyone, I'll see you next week. Oh, last thing. You're going to notice that the name has changed. Where it was called Lunch and Grow with Commercial Multifamily. Well, if you look in the back, you see now it says Commercial Multifamily Masterminds, an affiliate of GOB Network Apartment Investors. The reason why I changed the name is because we are growing exponentially. And we are no longer really a meetup group. We are really a group of masterminds. And so my Facebook page is Commercial Multifamily Masterminds. My group here is Commercial Multifamily Masterminds. This is where the minds come together and we make things happen. It is here where all of that takes place. So you're going to notice the name is shifting over to Commercial Multifamily Masterminds. So I thank you all for coming. And in reference to that Texas deal I have, the 10 unit, I put my contact information there. If anyone is interested, I'm going to finish underwriting it. And I'm going to, I wanted some insurance information. This particular deal, the owners are out of state. They have already brought the price down. I think that we could really grab it. So if someone is really interested, shoot me an email. Let's do it. And let's try to get this thing. It's 10 units, but it could go into our portfolio, right? All right. So thank you everyone for coming. I'm not going to be able to hang around till the last man leaves. I got to jump on another call. But thank you and thank Robert. Robert Beardsley, everyone. Robert Beardsley. Thank you.
Thanks, guys.
All right.
Thanks. Just getting ready to buy that book too.
All right.